Hello and welcome to the January episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. A warm welcome to 2024. This is our first episode of the year and a brand new season 4 of First Look ETF. We are so excited about it. It is great to have you with us. Coming up on today's program, we'll examine a newly launched ETF that targets international stocks with a value investing approach, and a new fund hitting the NYSE that showcases a unique income strategy geared toward high-income seekers. Plus, we'll examine a new ETF that invests in the commodities market. But first, to kick things off, as always, we've got Douglas Yones, head of ETFs from the NYSE. Hi, Douglas. Happy New Year. Great to see you.
Hi, Stephanie. Happy New Year. 2024, I'm sure it will be a new year, new us, but what won't be new is that the New York Stock Exchange will remain the home of ETFs, and First Look will remain one of the best shows that people could watch to find out what's happening in our industry.
Yeah, thank you so much. We're so excited about season 4. Okay, let's begin as we always do with the latest update on ETF launch activity. How are we looking?
Yeah, December closed out an amazing year, right? Just December alone, very busy. 56 new ETFs raising $1.6 billion in new assets under management. But look, 2023, it was really a historical year for ETFs. A record 537 ETFs launched with just about $600 billion in net cash flow coming into our industry. And that surpassed a lot of expectations for the year because most of the year really wasn't going all that well. And yet we crossed a number of different thresholds, and a lot of people are really excited moving into next year.
Yeah, you know, as you said, so many records broken last year. We also have more history being made, the launch of spot Bitcoin ETFs here in the U.S. markets. What does this mean for investors and financial advisors?
Yeah, look, the New York Stock Exchange for 231 years has been at the center of innovation, and that hasn't changed. As you mentioned, today was the very first spot Bitcoin ETFs traded here at the New York Stock Exchange. Our innovation is not ending. We are very excited, and you're going to hear about it in the show today. We're very excited to see what we're seeing, which is broad growth across the industry. A lot of people don't realize last year, about 35% of all cash flow went into fixed income. We're seeing innovation in income. We're seeing innovation in international names, options markets. These are just a few of the things we're seeing, and we're really excited about 2024. You're going to hear a lot about it in today's show.
Yeah, speaking of 2024, as the year unfolds, what are other ETF trends that you guys are taking a look at?
Yeah, we're watching a lot of different pieces. First and foremost, ETF conversions are going to continue to grow. Last year, over $13 billion converted directly from mutual funds and SMAs straight into ETFs. And by the way, the NYSE floor, bringing ETFs down here to the New York Stock Exchange historic floor, that is really starting to pick up. Already, we're only a couple weeks into the year. We've had 9 ETFs move down to the floor, and we have 2 more scheduled for later this month. So we're going to continue to see ETFs kind of go back to the future with respect to human trading alongside best-in-class technology. You can read all about it and learn all about it on our websites, or you can go to etfcentral.com. We do a deep dive on all the data and show the improvement in liquidity that the New York Stock Exchange can help for all ETFs.
So much excitement. We're looking forward to see what the new year brings. Thank you so much, Douglas. It is great to have you with us, and we'll see you soon.
Thanks, Stephanie.
And just a quick reminder to watch First Look ETF on Amazon Fire TV and Roku. We also simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms, so be sure to check us out. For some investors, finding undervalued investment opportunities in international markets might seem like a daunting task. But a new ETF from John Hancock with a hands-on approach and a disciplined framework promises to do the heavy lifting. Here to tell us more is Josh Jones, CFA Portfolio Manager at Boston Partners. Hi, Josh. It's great to have you with us.
Hi, Stephanie. Thanks for having me on.
So the John Hancock Disciplined Value International Select ETF, and that ticker is JDVI, recently joined the ETF lineup at John Hancock. And rather than taking a broad index approach to investing in international stocks, JDVI uses a highly selective screening strategy. Tell us more about it.
Yeah, so Boston Partners is an institutional quality active equity manager. We're effectively fundamental value investors, and we've been investing in the international market since 2008 and successfully. In 2018, we started incubating a fund that really focuses on applying our philosophy really to the large and kind of mega cap spectrum of the international equity market. So this is finding undervalued businesses that are higher quality and that should compound over time. That strategy's had a very successful track record. And when you kind of apply it to the international markets, generally what we find is value investing works. But when you go to the big indexes, a lot of companies that are well represented tend to be value traps. So there's just a more selective opportunity set. And it's really kind of fit nicely into an active ETF.
And when you're talking about these international markets, what are some of the top countries or regions where JDVI is allocated to? And then what are some of the fund's top holdings?
Yeah, so when we look at it just in terms of sectors, we've had a pretty healthy representation of industrials over time. You basically have some world-class industrial businesses in Europe and Japan. And really, because they're listed in the non-US markets, they're substantially cheaper than you see of comparable industrial businesses in the US market. Businesses like Siemens. We also like some metals and mining investments, and generally speaking, more of the metals and mining companies are represented. Canada, the UK, Australia. I just think when you look at the world right now in terms of some of the electrification trends, we are extremely undersupplied in copper. Just in terms of where copper demand could be in the next kind of 10 to 12 years. And some of the better opportunities within the copper space are in the non-US markets and represented in the fund. And then just regionally, we do like Japan. And Japan's been a market that's been kind of, maybe overlooked for a while. It's, value investors have come and gone and talked about it for quite a while, but finally we're starting to see corporate reform. And a lot of the Japanese companies that we own are talking more about, shareholder friendly activities. And that's quite exciting. And that's well represented in the fund as well. So
how do you see this fund being used by investors and financial advisors?
Yeah, so I think if you look at your financial advisor spectrum, the non-US marketplace in general is less familiar. So oftentimes they're willing to kind of outsource active management, if you will, to a firm like Boston Partners. But obviously, increasingly, they want really tax efficient strategies. So this should be a pretty nice blend where we're selectively picking what we think are the best companies in the international equity space with some of the tax advantages that you get with an ETF.
Josh Jones, Boston Partners, thank you so much for joining us here on First Look ETF. It's great to have you.
Thanks, Stephanie.
Commodities are a frequently neglected asset class within many investment portfolios. The oil market represents one of the most important groups within the overall commodities market. Well, here to discuss a new ETF that targets the oil market is Edward Rosenberg, head of ETF and fund management at Texas Capital. Hi, Edward. It's good to see you.
Hi, Stephanie. Thanks for having me on.
So the Texas Oil Index ETF, ticker OILT, OILT, is among your firm's latest ETF launches. Now, the fund has a unique strategy for investing in the oil market. Tell us a little more about it.
Yeah, it's different than what's been a lot out there. So the Railroad Commission, which I know sounds weird to say in Texas, publishes the amount of oil and gas that companies pull from the ground in Texas. And what we do is every year we will weight the index based on that report. So, and you have to have pulled at least 0.1% of oil from the ground for the last 10 years to be included. So that's the starting point. And as you keep pulling oil and gas from the ground, depending on the weight, how much you pull out, your weight will reset every March. It's very different than others because it's only revolving around what happens in the state of Texas and how much you consistently come through by taking oil and keeping your business going.
Yeah, that does sound very unique. OILT is also index linked. So how often is the fund index rebalanced and what else should investors know about it?
So it rebalances quarterly and it reconstitutes annually, which is every March. So it'll rebalance back to the weights set for how much you pull out at the end of every quarter. But it resets itself every March and so it reconstitutes. What's different is what's interesting about oil in Texas is Texas is the fourth largest producer of oil around the world and by far the largest in the US. And if you've seen the recent reports, there's been more oil pulled in the last year out of Texas than there has been before in years past. And so it's an alternative way to look at the oil market. And it really does for an equity product, which is the most important. It does own equities. Right now, it's got about 30 to 35 in that range. So it's not futures based. So you don't have to worry about those famous K1s that everyone hates. But you're really getting exposure to something that actually ties relatively close on a correlation basis to WTI, West Texas Intermediate. And again, it's one of those things that's just a unique thought process, bringing forth the state of Texas, what we do well, into an ETF that investors can invest in an easy way.
Are you able to share some of the names? I mean, might we be familiar with some of these companies?
Absolutely. Right now, the largest holding, it actually is my favorite ticker, which is FANG, because it always connotates something else, but it's Diamondback Energy. Right. Then you have ConocoPhillips, Pioneer, Occidental, ExxonMobil are the top 5 as an example. And it does own, what's different about this versus others, it does own some foreign securities. There are 2 Japanese companies as well as 2 European companies that drill within the state. And so those companies are included as well.
Yeah, that's very interesting. How do you see this fund being deployed inside a diversified portfolio?
Well, we always talk about commodities in some sense and people wanting exposure. And obviously the largest commodity, single commodity that comes out of the US is oil. So what people tend to do is they'll put a sleeve of whether it's alternatives or, it could be partnered with other natural resources. But if you really believe that oil is going to go up, this is where you'd want to invest in a sense. Oil is one of those things that obviously every time there's some crazy outbreak in Europe or somewhere else, that tends to, you'll see oil going up. And even with recent news around what's been happening, oil started to move. And in the end, what you're really looking at here is you're not just betting on oil, because there's Brent and others. What you're really looking at is you're looking to put oil in your portfolio in the fastest growing economy in the United States. And if you break down the United States to each individual state, Texas has been the fastest growing economy for a long time now. And so not only are you picking on oil, you're saying, I want to be part of something that has the fastest growing economy as well. Because in the end, Texas is also the #1 exporter state in the US. And a big portion of that is oil.
Well, we'll leave it there. Ed Rosenberg, thank you so much for joining us here on First Look ETF. It's great to have you.
Thank you so much for having me.
As the number of retirees swells, the demand for investments that generate sustainable and high income continues to grow. How can you enhance your portfolio's overall income strategy? Well, here to discuss a new ETF that targets high income opportunities is Jay Pestrichelli, portfolio manager and CEO at ZEGA Financial. Hi, Jay. It's great to see you.
Hi, Stephanie. Great to be back. Yeah, we have a unique fund that was recently launched in a partnership with Sofi, and the name of the fund is the Sofi Enhanced Yield ETF.
Yeah, the ticker there, THTA. Is it Theta?
Yeah, there's a little trick in that name. We do call it Theta, which should give you a little bit of a hint of what the strategy is about. Theta is the option Greek that represents time decay, like growth from time decay. And so that's really what this strategy is. You talk about a higher yielding strategy that's driven returns through selling options that benefit from the natural time decay of options, hence the name Theta. That's where it came from.
Very cool. Theta is also actively managed. What is the target allocation to the various income strategies used by the fund? And then how often are these allocations adjusted?
Yeah, Theta, we like to say Theta is appropriate piece for any investor, but again, depending on your risk appetite, we like to say between 10 to 20% allocation because it's more of an alternative income strategy, right? It's not stocks, it's not bonds. While there is a bond component to it, really the returns are driven by option premium, which is we would consider an alternative source of income. So when you think about modern portfolios and you think about how to rebuild these days, having a slice allocated to alternatives is important, anything that's not stocks or bonds. So we like to say between 10 to 20% because it's designed to kick out returns regardless of up, down, or sideways markets as it just benefits from the time decay of options.
Yeah, and that makes total sense, again, especially for people who are maybe, at or nearing retirement.
Yeah, exactly. When you look at a year like, say, last year, even 2 years ago, well, you had strong stock market returns and weak stock market returns the year before. A strategy like Theta will just kind of consistently kick out those returns that, have a very targeted number that can range from the 8 to 12% that's really directed towards capturing the volatility within the market. And that doesn't always mean you need markets to go up or down for it to generate returns.
And when you think of investors, how do you see a fund like Theta being deployed inside a diversified portfolio?
Yeah, I mean, we look at it truly as a diversifier because it will be like nothing else that you have in a traditional portfolio. Again, that option premium is a unique source of generating returns. Sometimes you'll capture that in some of the larger funds that are out there, but really this one focuses in on an alternative. So yes, we would definitely see the allocation as something that's unique in that 10 to 20% range.
Sounds great. Jay, thank you so much for joining us here on First Look ETF. And that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comment section below and by hitting the like button. Want to give a big thanks to all of our guests, along with Douglas Yones from the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thanks for watching. We'll see you next time.